Congrats, finance bros. You're finally going to be able to have a life. Or will you? Investment banking is notorious for having the worst work-life balance versus almost any other industry in the world. And back when I used to work at JP Morgan as an analyst, I constantly was working 80 to 100-hour weeks.
Sometimes work can be super miserable, like all the time.
But nowadays, with ChatGPT and AI just taking the world by storm, everyone is saying that we're going to be way more productive, work less hours, or maybe even have AI take our jobs.
What's going to happen is robots will be able to do everything better than us. I'm including, all of us, I'm not sure exactly what to do about this.
And so this got me thinking, as AI gets more advanced, will bankers work less hours? Will there finally be a utopia where finance bros will be able to clock out at a reasonable hour and finally have a life? In today's video, I'll be answering these three questions. First, how will AI change how analysts build presentations? Second, how will AI affect financial modeling? And lastly, will analysts finally be able to work less hours? One quick caveat before getting started, the predictions I'm making in today's video are just about the short term, let's call it the next 5 years or so, of how AI will change banking and the industry and how analysts work. In 50 to 100 years, theoretically, AI is supposed to be able to do everything that a human can do today. So let's not think about that. Let's just focus on the short term. And so with that, let's first go into how AI will change how investment banking analysts build presentations. Any investment banking analyst really has four main responsibilities, which include building presentations, building financial models, research, and managing deal processes. And we're only focusing on those first two in today's video because that really involves around 80% or more of an analyst's work. I think AI tools are going to be a game changer for analysts when they're creating pitch books. And a big reason for this is because a lot of the presentations that analysts build are kind of structured in the same way. So for example, when I worked on M&A presentations, we almost always had sections for a market update, our view on the client, and an valuation using trading and transaction comps and a DCF. Microsoft recently came out with something called Copilot, which allows you to reference other presentations and build out similar slides. And this is an example of a tool that I could see a lot of investment banking analysts use in the future. To give you one detailed example, when I was an investment banking analyst, the pages I hated to make the most were company profile pages or strips. And these were just basically either one pagers of companies that kind of talked about what their products were, kind of gave some basic financial information about them, maybe their stock price charts that I had to annotate. Strips were something where on one page you see 5 different companies and there's a description for each of them, but they have to be really kind of detailed. And so they were always really, really annoying to make. I can totally imagine in the future telling an AI tool like Microsoft Copilot, make me a slide similar to this previous profile page, but make it for company X, update the stock price chart and annotate it on the dates where the stock moved more than 2%, summarize and add the latest 5 press releases from the company, and update the financial summary section as of yesterday's market close, and have all of this be automated. There are also more complicated pages like valuation football fields where I can imagine telling an AI tool, hey, reference this old football field slide, but replace everything with the data in my new Excel spreadsheet and having all of this be automatically populated. Now, to be clear, even in these next 5 years, I don't think an AI tool will be sophisticated enough to make everything perfect, but I do think they would be able to create a really strong foundation for any analyst to work on a lot of different pages that are kind of automated. And so they have something to work with rather than starting from scratch. And if I was able to have this kind of tool as an investment banking analyst back in my day and not have to create 50 to 100 different strip profile pages, man, that would have been amazing. Now, before moving on to how AI will affect financial modeling, on the topic of financial modeling, if you're interested in breaking into investment banking and that's why you're watching this video, there is a resource I highly recommend called Wall Street Prep, which teaches you how to build financial models. Wall Street Prep offers financial modeling courses so you can be ready not just for interviews, but your job on the desk as a banker. And what I really like is that they have you dig into financial statements and build models using real numbers, just like what I used to do at JP Morgan. Wall Street Prep offers a lot of great courses, but the two I particularly recommend are the accounting course if you don't have any prior accounting knowledge, and then the premium modeling package, which has been taken by over 100,000 students and goes over all the key valuation concepts I learned in banking like DCFs, comps, accretion dilution, and LBOs. Wall Street Prep has been around since 2004, and the company helps train employees at all of the top banks and institutions in the world, including at Wharton, where my classmates have been attending live instructor sessions. The best part is, if you're interested in this course, you can use my code RareLiquid to get 20% off of any course, and I'll leave a link to all of this down in my description below. All right, now moving forward, let's discuss if AI tools will be able to help investment banking analysts with financial modeling. I think trying to predict how AI is going to affect financial modeling is a lot more complicated because financial modeling is more complicated. And when it comes to the more simple exercises like trading comps, transaction comps, or street-based DCFs, I think those will be able to get much more automated to a certain point. But when it comes to very, very advanced DCFs that are very, very specific to a client or are based off of management assumptions and a management model that is very, very hairy and has a lot of issues, then I don't know. I think it'll take a long time for AI to be able to really create models based on those kinds of scenarios. And let me kind of explain what I mean. In banking, one of the most common valuation models is the discounted cash flow analysis. And there are two main types of DCFs bankers build, which are either based on Wall Street equity research estimates and then management estimates. Street-based DCFs are a lot more simple because you're just using estimates that already exist and you pretty much just plug and play them. And I've made a ton of videos that you can watch of me building street-based DCFs. For these easier modeling exercises like street-based DCFs, I think there are a lot of opportunities for AI in the near future to be able to help automate a lot of things to help make investment banking analysts a lot more productive. And so, for example, I can imagine AI tools helping set up models. I can imagine telling an AI tool, reference this previous DCF Excel file for Google and replace all historical figures and estimates for Apple instead, and having this tool auto-populate this entire model. I also think there's an opportunity for AI tools to help with forecasting because whenever you're building a DCF, you're looking 5 to 10 years out into the future. And so you're going to need to do research into where you think the industry is going or where this company is going to go. Back when I used to be an analyst, I had to dig into 30 to 100 page industry reports to try to figure out what the industry averages were when I was trying to project out things like revenue growth and margins. I can imagine in the future asking an AI tool something like, find me the projected growth of the enterprise software industry from years 2024 to 2030 and provide 5 different sources, links to each report, and the page number for each, making projecting financials a whole lot easier. And so for easier modeling exercises, I can totally see AI being very helpful in the near future. But when it comes to much more complex DCFs that are based on management models, I think this is where AI may not be very helpful in the near future. And that's just because these kind of management models can get very, very hairy. And let me kind of explain why. Investment banks are not cheap. And so if you're using an investment bank because you're either trying to buy a company or you're trying to sell yourself as a company, this means that you're probably a pretty big company and you're selling thousands, if not millions of products a year with different types of prices and thousands of different types of SKUs and different types of products, which means that there are just hundreds of thousands, if not millions, if not billions of data points. And your finance team is in charge of getting all this information and kind of summarizing them into the key main line items. But a lot of times finance teams get really lazy and the Excel spreadsheet that they use to kind of keep track of everything just becomes a huge mess. I've seen a lot of management models where there'd be 25 to 100 plus tabs and very important assumptions would just be simply hard-coded, or there would be numbers that don't tie from one tab to another. And these are for important metrics like revenue, EBITDA, net income, and etc. Whatever the case may be, investment banking analysts have to go into the Excels and really make sense of everything, tie the numbers where they need to be tied, and kind of clean up the entire model, especially if the finance team at that company hasn't been doing a meticulous job. And you might be surprised, most finance teams, when they send over their management models, there's a ton of issues with it. From my understanding, AI tools work best when you give them a large kind of data set that they're able to be trained on. But the thing with management models is that although there are a lot of similar things like revenue, EBIT, EBITDA, and important line items that all companies will kind of have to have in their models, the models themselves are very, very esoteric and different from one another. So I think it'd be kind of hard in the near future for an AI tool to just give them a management model and be like, hey, build me a DCF based on this information. But I will say I can imagine an AI tool helping locate the errors in a model and suggesting areas of issues. For example, I could imagine telling an AI tool, the revenue figure for 2023 in tab 1 doesn't match the revenue figure in tab 23. Why is that? And then having the AI tool provide some examples of potential reasons. Two really quick things before moving forward. If you're interested in breaking into investment banking, I'm selling the resume and cover letter that got me into JP Morgan, which you can check out on rareliquidcareers.com. I'm also building out my own how to get into investment banking course and giving out 50% discounts for people who sign up early using my link down below in the description. All right, so this all leads now to the million-dollar question. Will investment banking analysts finally be able to work less hours? At least for the next 5 years, and honestly, I'd say even for the next 10 years, I would say that investment banking analysts will probably still be working the same hours. And let me kind of give you the history of investment banking to explain why. Back in the 70s and 80s, investment bankers didn't have access to the internet. So they had to actually go to the library, photocopy financial statements, and oftentimes build models by hand. And by hand, I mean pen and paper. So that's kind of crazy. Then in the 90s and 2000s came the personal computer and the internet, which meant that you can look up financial statements online and also that you could build financial models in Excel. Fast forwarding to the present day, investment banking analysts can now use resources like FactSet, CapIQ, and Bloomberg in order to instantly just pull numbers into their Excel spreadsheets. And also with personal laptops and just tech in general just being way better now, investment banking analysts are way more productive now than they've ever been before. Now, in all three of these periods that I've just mentioned, the resources and tools have changed dramatically. Investment banking analysts have been way more productive, but you know what hasn't changed? Investment banking analysts working 80 to 100-hour weeks.
There is so much more work to do.
Of course, there's a reason for all of this, and it's because investment banking is about three things, which is perfection, velocity, and frequency. Starting with perfection, every single letter and number in an investment banking pitch book needs to be absolutely perfect. And so even if on page 57 in the appendix, in the footnote, at the very bottom in size 8 font, there's a double space instead of one space, or there's a capital letter where it should be a lowercase letter, your associate or your VP or your MD is going to catch that, and you're going to need to fix it as an analyst. So even if an AI tool is able to create a kind of profile page for you or build out like a street-based DCF, as an analyst, you're still going to have to check every single number, check every single detail, and that will always take manual hours, which will take time. Okay, I don't know if you caught it, but I know I'm struggling with my words a bit and mispronouncing analyst, but that's because it's 4 a.m. right now and I'm trying to finish this video. If you could just really help out by sharing this video with a friend after you're done or liking this video, that would really help with the algorithm, and I'd really appreciate it. Anyway, going to my second point of velocity, investment banking, especially if you've not worked in the field, may seem like a very glamorous type of industry from the outside looking in, but it is a client services business and industry. So at the end of the day, you are the client's bitch. As a result, if your client has engaged your bank on a multi-billion-dollar deal and your MD is set to earn millions of dollars in fees for the bank, which means he gets a really big bonus at the end of the year, then he is going to have no regard for your life, and everything that you need to be working on needed to be done yesterday. So what you're going to have to do is build a financial model within the next few days, and then a presentation in the following few days after that, and everything is just super fast. And so even if an AI tool is able to help kind of build a foundation, as I said, because everything needs to be perfect, you're just still going to need to do a lot of work. And you're not going to need to just do a lot of work, you're going to need to do it extremely quickly. And so that's what I mean by velocity. This leads me to my third and last point, which is frequency. And investment banks get really paid based on the deals that they bring in and the number that they close in terms of transactions. And so even if an investment banking analyst is able to get a lot more productive, just as they have since the 1970s, 80s, and onwards because of all these tools and resources that they have now, all that just means is that an investment banking analyst is going to have to be even more productive, create more pitch books, and more financial models. I don't even need any AI tools to know that this is going to be true because I have experienced it firsthand. When I was just starting my job as an investment banking analyst, I knew nothing, and I was so incredibly slow, could barely kind of handle like 1 or 2 deals. And then just a year later, I was suddenly working on 10 different types of projects or 10 different projects at once. And they weren't all live deals. And sometimes when I'm working on one really intense live deal, that's all I could manage. But there are times when I was working on like 5 different marketing books, a few live deals that had small things going for them, and then like one or two like really intense live deals. And so that just is an example of, even if you get more productive as an analyst, it doesn't mean you have less work. It just means that you do way more work. As a result, in the next 5 years and onwards, I do think AI is going to be a huge game changer in a lot of ways. And I could obviously be totally wrong in my predictions, but do I really think that Chad, our finance bro, on a random Wednesday a few years from now will be able to be sipping on like a mocktail because he got out of the office early?